Picture a retired couple who spent 35 years paying off a beautiful brick home in the Midwest. They spent months researching the perfect place to spend their golden years, eventually settling on a sunny coastal town. They packed up their lives, sold the old house, signed the papers on their new retirement oasis, and filed a standard change of address form. It felt like the ultimate fresh start. But 6 months later, an unexpected letter arrives in their mailbox from the tax department of the state they thought they left behind. The letter states that because they still kept a small local bank account, retained their old family doctor, and spent a few weeks visiting their grandchildren back home, their old state still considers them full-time residents for tax purposes. They are now being audited, and the state is demanding a percentage of their entire retirement income. This scenario happens to well-meaning retirees every single year. Moving to a new state in retirement sounds simple, but beneath the surface lies a web of hidden state-level rules, overlooked residency laws, and quiet tax traps that can catch you completely off guard. If you are a senior homeowner, a retiree managing a nest egg, or an adult child trying to help your aging parents relocate, you cannot treat a cross-country move like a simple change of scenery. This is a major financial pivot. We are not sharing this to make you panic or discourage you from moving closer to the grandbabies or the beach. We are sharing this because the tax systems in different states look at your retirement money through completely different lenses. The danger is not that you are trying to break the rules. The danger is that the system automatically follows the paperwork you leave behind. Today, we are going directly through the 5 specific state tax rules you must understand before you hire a moving truck, so you can protect your hard-earned money, your home, and your family's peace of mind. This video is specifically for individual retirees, married couples, senior homeowners, and widows or widowers who are actively planning or considering a move to another state. It is also essential viewing for adult children who are coordinating a relocation for their elderly parents. There is a common belief in the retirement community that if you move to a state with no state income tax, your tax problems disappear overnight. But state budgets are complex machinery. A state that does not tax your income may make up for it with exceptionally high property taxes, local sales taxes, or hidden administrative rules that make it incredibly difficult to cut ties with your previous home. To clear things up right away, we are not talking about federal income taxes or the IRS. Those rules remain the same no matter which state line you cross. Instead, we are looking at the aggressive and often conflicting rules enforced by individual state tax agencies. Because every state has its own specific definitions of residency and its own unique set of tax exemptions, what works beautifully in one part of the country could trigger a financial headache in another. The 4th rule we will discuss today is perhaps the most critical because it deals with something most families don't discover until a medical emergency or a passing occurs, and it can completely change how your estate is handled. But before we look at how states handle your property and your legacy, you need to understand how they look at your physical presence. Rule 1. The trap of dual residency and the 183-day illusion. Let us start with what most people think is a golden rule, the 183-day limit. You have likely heard from friends or financial columnists that as long as you spend 181 days or fewer in your old state, they cannot tax you as a resident. People think it is a simple matter of counting calendar days. Unfortunately, what actually happens is far more complicated. Many states use a concept known as statutory residency. While it is true that spending more than 183 days in a state can automatically make you a resident for tax purposes, spending less than that does not automatically make you a non-resident. If your old state believes you never truly abandoned your permanent home there, they can claim you are still a resident and attempt to tax your worldwide income, regardless of where you spent the winter. Think about a retired nurse named Linda. She buys a condo in a tax-friendly southern state, but keeps her original home up north so she can spend summers near her daughter. She carefully tracks her time and spends exactly 5 months up north and 7 months down south. She assumes she is safe. But during a routine check, her northern state looks at her lifestyle. They find that her primary bank accounts are still at a local credit union up north. Her car is registered there, her primary doctors are there, and she still holds a library card in her old neighborhood. To the tax auditors, Linda never truly left. They issue a claim for back taxes on her pension and investment income. The lesson here is quiet but powerful. The system follows your ties, not just your calendar. To successfully move your tax home, you have to prove an intent to permanently abandon your old state and establish a new life in the new one. It means changing your driver's license, registering your vehicle, moving your primary banking relationships, updating your voter registration, and moving the items that carry personal meaning to your new address. A 5-minute review of your personal connections today can save your family months of stressful administrative audits later. Rule 2. The pension sourcing misconception. The second hidden rule involves how states view your retirement income streams, particularly traditional company pensions, 401k plans, and traditional IRAs. A very common fear among retirees is that if they earn their pension while working 25 years in a high-tax state like New York or California, that state will continue to tax their pension checks even after they move to a state with no income tax. Fortunately, there is a piece of good news here that many seniors miss. Under a federal law passed in the 1990s, states are strictly prohibited from taxing retirement income from qualified pension plans, 401ks, and traditional IRAs if you are no longer a resident of that state. Once you legally change your residency to a new state, your old state cannot touch your monthly retirement checks. However, here is where the paperwork becomes more powerful than the promise. This protection only applies if you have cleanly and legally established your new residency under the rules we just discussed. If you fail to properly cut your residency ties, your old state can still claim you as a resident and tax that money anyway. Furthermore, this federal protection does not always apply to certain types of non-qualified retirement plans, deferred compensation packages, or specific business sale payouts that small business owners often rely on for retirement. If your retirement income contains unique corporate structures or non-standard payout agreements, your old state may still have a legal claim to a portion of that money at the source. This is exactly why you should never assume your income is fully protected until you review the exact structure of your retirement accounts with a qualified professional in your state. Rule 3. The property tax exemption reset. The third major rule involves your home, and it is the one that senior homeowners discover too late, usually a year after they move. When you look at the real estate listings in a new state, the current property taxes listed on the home look completely affordable. You crunch the numbers, see that they fit your retirement budget, and buy the property. But here's the catch. Many states offer deep property tax discounts specifically for seniors, low-income retirees, or long-term residents through programs like homestead exemptions or senior tax caps. The low property tax amount you see on that real estate listing is often based on the previous owner's senior exemption or a tax cap that had been building up for 20 years. The moment that property changes hands, those old exemptions are completely wiped out. The home is reassessed at its current market value, and the tax rate resets to the full amount. Consider a retired veteran who moves to a new state, expecting his housing costs to drop. A year after closing on the house, he opens his new property tax bill and realizes it is double what the real estate agent estimated. Why? Because the previous owner was a 90-year-old widow who qualified for 3 different local tax exemptions that did not automatically transfer to the new buyer. Before you purchase a home in a new state, you cannot just look at the current tax bill. You need to call the local county assessor's office directly. Ask them what the property taxes will be after the sale is processed and the valuation resets, and find out exactly what forms you need to file to claim the local senior or homestead exemptions as a new resident. Rule 4. The estate and inheritance tax cliff. This leads us to the 4th rule, and it is the most dangerous because it affects the legacy you leave behind for your spouse and children. Most Americans know that the federal estate tax exemption is very high, meaning the vast majority of families will never owe a single dime to the federal government when a parent passes away. Because of this, retirees assume their estate is entirely safe from death taxes. But several states enforce their own independent state-level estate taxes, or inheritance taxes, and their exemption limits are vastly different from the federal government's rules. While the federal exemption protects millions, certain states begin taxing estates at much lower thresholds, sometimes starting at $2 million or even $1 million. Let us look at a realistic family scenario. Imagine a retired couple with a paid-off home, some modest life insurance, and a healthy retirement account. Together, their total assets add up to $2.5 million. Under federal law, if one passes away, there is no estate tax whatsoever. But if they live in a state like Massachusetts or Oregon, where the state-level estate tax exemptions are capped at lower limits like $1 or $2 million, their family could suddenly face a substantial state tax bill within months of their passing. Worse yet, some states like New York feature an estate tax cliff. If your estate exceeds the state exemption limit by even a small percentage, the state can retroactively tax the entire estate, not just the amount over the limit. There is also a major difference between an estate tax and an inheritance tax. An estate tax is taken directly out of your assets before anything is passed to your heirs. An inheritance tax is a separate tax that your children or relatives must pay individually upon receiving their share of the money. If you move from a state with no death taxes to a state with an aggressive inheritance or estate tax system, your existing will or trust may no longer protect your assets the way you intended. This does not mean you should panic. It means you should check. Your estate planning documents must be reviewed by a local professional whenever you cross state lines to ensure your family isn't left dealing with an unexpected tax bill during a time of grief. Rule 5. The part-year resident tax form puzzle. The 5th and final rule is purely administrative, but failing to navigate it correctly is what triggers automated IRS data matching flags and state tax audits more than almost anything else. It is the complex math of the moving year itself. When you relocate in the middle of a calendar year, you do not just file one simple tax return the following April. You generally have to file part-year resident returns in both states. You must meticulously slice your income down the middle, showing exactly how many dollars you earned while living in your old state and exactly how many you received after crossing crossing into the new one. This is where many seniors accidentally make the problem worse. They assume that if they move on July 1st, they can just report half their income to each state. But what if you withdrew a large lump sum from your IRA in March to pay off the moving expenses? That specific income belongs entirely to your old state. What if you sold stock in November? That belongs to your new state. If the numbers on your state forms do not perfectly align with the federal 1099 and W-2 forms reported to the IRS, the automated state tax systems can flag the discrepancy. They may assume you are hiding income, resulting in automated penalty notices that can take months of professional correspondence to correct. The year you move is the most logistically complicated financial year of your retirement, and treating it like a standard tax year is a recipe for expensive administrative errors. Now that we have walked through these 5 hidden rules, let us look at the good news. You have full control over how this story plays out. Protecting your retirement nest egg from these state-level traps is a matter of taking practical, deliberate steps before and during your move. First, create a clean physical break from your old state. Once you buy or rent your new home, immediately prioritize updating your baseline legal documents. Do not wait 6 months to change your driver's license or vehicle registration. File for your new state's homestead or senior property tax exemptions the very first week you are eligible. Second, treat your financial accounts like a trail of breadcrumbs. Close out small local bank accounts in your old state and establish accounts with institutions that have branches in your new home, or transition to a national banking platform. Update the billing addresses on every single credit card, insurance policy, and investment account simultaneously. Third, perform a comprehensive review of your legal documents. A will written under the laws of one state is generally valid in another, but the administrative processes, probate rules, and power of attorney forms can vary significantly. Have a local estate planning attorney in your new state review your documents to ensure your medical wishes, financial powers of attorney, and beneficiary designations are optimized for local state laws. To summarize everything we have discussed today, moving states in retirement is an exciting milestone, but it requires serious structural planning. Remember that state tax agencies look at your lifestyle and your permanent connections, not just a calendar count of days. Your pension income is protected from your old state by federal law, but only if you have cleanly established your new tax home. Property taxes can reset dramatically when a home changes hands, and state-level estate or inheritance taxes can quietly impact your family's inheritance if you aren't careful. Finally, the year of your move requires careful, line-by-line tax filing to avoid automated system audits. This information is designed to help you protect your control over your retirement and ensure your hard-earned money stays exactly where it belongs, with you and your loved ones. Rules can vary significantly by state, and your personal financial situation is unique, which is why we always encourage you to review your moving plans with a qualified tax, legal, or financial professional in your specific area before making any major changes. If you found this guide clear and helpful, please consider sharing it with the family member who helps keep track of your paperwork, or with friends who are currently planning their own retirement moves. Before you go, let us know in the comments, which of these rules surprised you the most, or which document would you like us to explain in plain English in our next video? Is it the property deed, the beneficiary form, the power of attorney, or how states handle Social Security survivor benefits? Thank you for watching. Take care of your health, protect your hard-earned savings, and we will see you in the next video.